One of the big companies reporting earnings this week is 3M, which is currently trading at $141, and over the past year they are up by 33%. Now jumping straight to my stock valuation spreadsheet, I have already plugged in the ticker MMM and all the metrics have shown up automatically. Now the first thing we can see is their trailing free cash flow payout ratio sitting at 72%. Now I don't really mind MMM's payout ratio being this high as they don't need to direct a lot of their free cash flow into innovation. Jumping straight to the 9-pillar analysis, we can see that they get a rating of 6 out of 9 with 3 pillars currently in the red. And first let's have a look at the company's growth. You can see that their 5-year revenue CAGR is sitting at only 0.43%. Their 5-year free cash flow CAGR is sitting at only 2.27%, and their net income actually seems to have been decreasing at quite a high rate. If I zoom in closer to the net income, we can see that indeed it has been negative in 2024, sitting at about negative 7 billion. So overall, the growth of the company isn't looking that great. They have very slow growth, but that is quite expected as they are in the industrial sector, which overall isn't a fast grower. But now let's also have a look at how valued MMM currently is compared to their earnings and compared to their free cash flow. So their 5-year P ratio is sitting at 10.24 and their 5-year price to free cash flow is sitting at only 14.5. If we zoom into pillar 1, you can see that their current P ratio is sitting at 17.81, which is above the 5-year average, but it is in the range we would like it to be in for the stock to be considered fairly or undervalued. And regarding the free cash flow, the price to free cash flow, that is currently sitting at 15.43, again slightly higher than the 5-year average, but in the range we would like it to be in. So 3M might as well be under or fairly valued compared to the earnings and compared to the free cash flow they are currently generating. Something I like about the company is that they have decreasing shares outstanding at a rate of 1% yearly over the past 5 years, and that they don't have too much debt. Their long-term liabilities over their 5-year free cash flow negative dividends ratio is sitting at only 2.32, which means that they can pay off all their long-term liabilities in about 13 years, which is quite decent. Now you can see that their 5-year profit margin is sitting at only 8.64% over the past 5 years. But if I zoom in closer to pillar 6, you can see that that is because it was negative in 2024. Overall, it was sitting at about 14 to 16%, and currently it is sitting a little lower at 13.45%, but that is still above the 10% we would like to see. So 3M currently seems to be quite profitable. Also, if I scroll down to the return on invested capital, you can see that in 2024, it was sitting at 20.33%, which is the highest it has been in over the past 5 years, so that is great. Now, one thing I do want to point out is that 3M did cut their dividends. So their 5-year dividend growth is sitting at negative 4.48%. If I zoom into pillar 8, you can see that they haven't been growing their dividends too much over the past 5 years, growing them at 2%, 0.68%, 0.68%, and over the past 12 trading months, they cut them by 26.50%. So big dividend cut made by 3M. But now let's figure out if before their earnings call and at their current trading price, they are still considered a buy. So jumping to the grams formula revised, I will project a 5-year earnings growth estimate of 5.81% and get an intrinsic value of $68.43, which is more than 100% lower than the current trading price. Now for the second valuation model, we will compare 3M to its future free cash flow. So I will calculate a growth rate of 3.2% into the future, and plugging in a discount rate at 8.2%, we will get an intrinsic value of $176.61, which is higher than the current trading price. For the third valuation model, I will compare 3M to 2 of its competitors and get an intrinsic value of $203.61. And finally, moving to the discounted cash flow model, I will get an intrinsic value of $84.24 after projecting a growth rate of 1% into the future. And finally, when we move to the ultimate valuation and average out the 4 valuation models, we will get an ultimate intrinsic value of $133.22, which is 5.5% lower than the current trading price. The second company I want to have a look at today is Verizon Communications, which over the past year is down by about 0.23%. Jumping straight back to the stock screen, I will plug in the ticker VZ for Verizon and wait for the metrics to show up. And right away you can see that they are reporting their earnings on the 24th of January, which is Friday. And by the way, if you do enjoy these valuation spreadsheets, make sure to download them at the link in the description. Now, one of the reasons why many investors love Verizon is their high dividend yield, sitting at almost 7%. The company does have a slightly higher trailing free cash flow payout ratio, sitting at 57%, but I'm quite fine with that. So jumping straight to the 9 pillars, we can see that they get a rating of 6 out of 9 with 3 pillars currently in the red. And as before, let's first have a look at the financial growth of the company. Their revenue has been increasing at a rate of 0.39% yearly, their free cash flow has been increasing at a rate of 5% yearly, and their net income seems to have been falling as well. If I again zoom closer to pillar 4, the net income, you can see that in 2024 it fell to 11.6 billion from 21.2 billion in 2023. So like 3M, Verizon seems to be a slow grower. But now let's jump back to the 9 pillar analysis and have a look at some of the other pillars. First, let's have a look at the decreasing shares outstanding. And Verizon, unlike 3M, has actually been selling out shares at a rate of 0.38% yearly. And I don't really like that, because a well-established company such as Verizon shouldn't need to sell out shares to generate free cash flow, especially when they are trading undervalued compared to their historical price to earnings. The company also has a lot of long-term liabilities. You can see that their long-term liabilities over the 5-year free cash flow negative dividends ratio is sitting at about 5. And so this tells us that Verizon doesn't generate enough free cash flow to cover all their dividends and pay off all their long-term liabilities in a safe time period. Now let's also have a look at the company's dividend growth. Over the past 5 years, their dividends have been growing at a rate of 1.88% yearly, which if we zoom to pillar 8, you can see is actually below the average stock year-over-year dividend growth, which from my side certainly isn't great, because as a dividend investor, I look for companies that have a dividend growth of above 4%, as one day I want to be able to live off dividends. But your goal of course might be different to mine, so Verizon, especially with their high dividend yield, might be something you are looking for. Now jumping back to the 9 pillar analysis, let's also have a look at the 5-year PE ratio of the company and the 5-year price to free cash flow. You can see that the 5-year PE ratio is sitting at 13.66 and the 5-year price to free cash flow is sitting at 11.25. Both of these are in the ranges we would like them to be in, so Verizon would be considered undervalued compared to the earnings and compared to the free cash flow they have been generating over the past 5 years. Their 5-year profit margin is also sitting nice and high at 13.84%, which is in the range we would like it to be in. And now that we have gone through the 9 pillar analysis, let's calculate Verizon Communications intrinsic value. So first, jumping to the grants formula revised, I will predict the high earnings per share growth at 3.5%, the medium at 3% and the low at 2%, and get an intrinsic value of $45.83, which is 15% higher than the current trading price. For the second valuation model, the discounted cash flow model, I will project a high growth of 5%, medium of 4% and low of 2%, and average them out to 3.7%. I would then plug in a discount rate at 8.8% and get an intrinsic value of $46. Now for the third valuation model, I will compare Verizon Communications to T-Mobile and AT&T and get an intrinsic value of $49.98. And finally, for the dividend discount model, I will predict the high growth at 2%, the medium growth at 1.5%, and the low growth at 1%, and we will get an intrinsic value of $36.77. And finally, averaging out the 4 valuation models, we will get an intrinsic value of $44.65, which is 15% higher than the current trading price, and with a 15% margin of safety, we would get an acceptable buy price at $37.95, which is only slightly lower than the current trading price. And now let's move to the third stock of the video, and that is American Airlines. You can see that this company is rated strong buy by the quant, a buy by Wall Street, and a buy by SA analysts, and over the past year they are up by 41.30%. So jumping straight to my stock valuation spreadsheets, I have already plugged in American Airlines ticker symbol and all the metrics have shown up automatically. And as before, if you'd like to download these spreadsheets for your own personal use, you can always do so at the link in the description. Now in 2021, the company actually stopped paying out their dividends because of COVID. They didn't generate enough free cash flow to pay out dividends, so they cut their dividend payments. And in my opinion, this was a great call as it allowed them not to go into debt. Now jumping straight to the 9 pillars, we can see that the company gets a rating of only 3 out of 9 with 6 pillars currently in the red. So first let's have a look at the growth of the company. If I jump to pillar 3, you can see that the revenue of the company has grown from 17.3 billion in 2021 to 52.7 billion in 2024. So that's some very decent growth in the revenue. Their net income also increased from negative 8.8 billion in 2021 to 822 million in 2024, and their free cash flow increased from negative 8.6 billion to 1.2 billion in 2024. So American Airlines is performing some great growth in their revenue, free cash flow, and net income. Now let's have a look at some of the metrics currently sitting in the red. First, let's have a look at the debt of the company, which is the thing that scares me the most. If I jump back to the stock screener, you can see that the market capitalization is sitting at 12 billion, while the enterprise value is sitting at 42 billion. The difference is essentially debt. If you direct your attention to the balance sheet, you can see that the total liabilities actually exceed the total assets. So the company currently has negative total equity. So when you buy shares of this company, you are essentially buying their debt, which certainly isn't optimal. Now jumping back to the 9-pillar analysis, you can also see that they have been increasing their shares outstanding at a very high rate of about 9.5% yearly over the past 5 years. And this is a way to battle the high debt they currently have, because by selling out shares, they are generating free cash flow. Now you can also see that their 5-year profit margin is sitting at negative 10.48, but if we zoom into pillar 6, you can see that currently it is sitting at about 0.51, so the company has been raising their profit margin. And if I scroll a little down, you can see that the return on invested capital has also been rising over the past 5 years, in 2024 sitting at about 5%, so the company is certainly recovering. Now let's also have a look at their 5-year PE ratio and their 5-year price to free cash flow. Their 5-year PE ratio is sitting at 20.22, but if I zoom into pillar 1, you can see that currently it is sitting at 52.20, indicating an overvalued stock compared to their earnings. But if I jump to pillar 2, that is the price to free cash flow, that is currently sitting at 10.88, so American Airlines would be considered undervalued compared to the free cash flow they are currently generating. So overall, the company does seem to be recovering after COVID-19, but for my taste, there is still too much risk that comes along with the investment. But of course, with higher risk, there comes higher potential return. And so let's calculate the company's intrinsic value, first as always using the grams formula revised. And here, instead of the 5-year earnings per share, I plugged in the current earnings per share, as the 5-year average is sitting in the negative. I plugged in the 5-year earnings growth estimate at 25.28% and got an intrinsic value of $14.03, which is still 30% lower than the current trading price. For the second valuation model, I plugged in a growth rate of 17% into the future and got an intrinsic value of $20.76 after plugging in a discount rate of 9.6%. And I did plug in the discount rate quite higher than the WACC of the company, as I do want a little bit of a buffer zone. Now moving to the third valuation model, I will compare American Airlines to one of its competitors and get an intrinsic value of only $9.32. And finally, we will skip the dividend discount model, as American Airlines stopped paying out their dividends, and arrive straight to the ultimate valuation, when we average out the 3 valuation models, we will get an intrinsic value of $14.71, which is about 19.5% lower than the current trading price. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.